So we are starting up now. Welcome everybody to this interview that I'm doing here with David Goncalves. He's with the Vine Group, and David is he's done several workshops with me in the past when we were able to do them in person, and he's full of wisdom and knowledge and experience. And I mean it when I say that. You tend to have this insider scoop information, and you're very well connected in the finance industry. So I'm glad that we're able to get you here and to share what you have or what you know about what's going on in the banking industry, in the finance industry, in the mortgage industry. So I do want to tell everyone here that we are encouraging interaction. So if you guys do have a question, you can either unmute yourself and ask, or you can post it in the chat button on below the screen. When you hover over the screen below, you'll see a chat button. And yeah, feel free. This is going to be interactive. And I know, David, you have a couple slides that you'll show that will relate to whatever topic that we're talking about.
Mm-hmm.
And yeah, so please, I guess go ahead and tell us a little bit about who you are, other than what I said.
Well, wisdom. I love that word. Well, I own a mortgage brokerage. We're a Vine Group. We're part of Mortgage Alliance. We operate at a national level across the country. We do about $1.4 billion in business every year, and growing. We do a lot of work with investors in big and small markets, residentially and commercially. So, you know, we've been getting a lot of calls and questions with regards to what's going on in the marketplace and how things are, how people are being affected, and how should they strategize and plan for the next wave of, you know, normalization, if you would, right? You know, so, yeah, so, you know, we can definitely give a little bit of insight as to what's going on in the marketplace and show a little bit, share a little bit of what we are learning, because I have to say that the whole concept of business as usual has changed, and it's changing extremely fast. And I think one of the things we all have to remember is that we've seen something very similar to this during the credit crisis, but at a much, much different pace. It was a little bit slower. Things moved at a more logical pace. Now, it seems like every day there's a change going on in the world of lending.
All right. Well, I guess there's a topic that a lot of people are wondering. Actually, all these topics that we're going to be asking you have been questions that I've been hearing a lot. And well, let's start off with interest rates.
Yeah. So you know, interest rates. I think that the real question here is what's started changing in the marketplace. Like, I'll share these slides here. I'm just going to put screen number 2 on here, and kind of give you guys a perspective as to what's going on. So you see the screen?
Not yet.
No.
No.
I hit share. We just tried this a little while ago and it worked. You see it now?
Nope. Unless other people can see it. Nope. Now I can see it. Yep.
Okay. Perfect.
Yeah.
So yeah. So basically, you know, in the COVID environment, things are definitely changing. You know, so I think the thing that's what's happening with mortgage rates is that basically rates have even though we've seen prime rate drop and it looks like rates have been dropping, but the fact is the rates actually have been rising during the initial stages of COVID. There was a liquidity problem with the marketplace and confidence. So we saw that with the banks having to increase their rates to try to motivate their investors to continue keeping confidence in their mortgage transactions, in their mortgage portfolio. So we actually saw, as the Bank of Canada cut their rates, we saw the 5-year fix go up to roughly 3.1 from roughly 2.69, and we saw prime rate go down, you know, a whole percent point, right? So it was an inverse effect. This seems to have been settled now with regards to interest rates. The Bank of Canada has come in and has worked with the industry to securitize some of the debt. What that means is it's happened during the credit crisis where banks will issue a mortgage or a line of credit, even though it's not a CMHC product in the terms that you have lots of equity in your home. The Bank of Canada through CMHC was still guaranteeing those loans for the bank, and this created a lot of confidence in the world markets. And that now we're starting to see the normalization of that, right? That seems to have been sorted out. The other thing that the banks did were they were basically putting out a bunch of requests for mortgage deferrals. This number has been increasing slightly, but they had about 500,000 mortgages, and that's individual units that were given deferrals. That deferral doesn't come for free. It's basically added on to the cost of funds. So the part of that rate increase was the fact that the banks were basically trying to figure out how much is it going to actually cost us to make these deferrals. And yes, we're going to get that money back down the road, but we're not getting it in the short term. So we're going to have to increase our margins, right? So as far as lenders go, I think mortgage demand dropped dramatically. Lenders also, I believe, felt like they wanted to do that because they were getting all these servicing requests for deferrals, that they basically turned around and said, hey, let's not try to encourage financing right now. Let's just service what we have, and let's make sure we take care of the clients that are calling in with distress and try to mitigate any default. And there was no fighting for market share. Everybody was priced at the same level. Good news is that seems to be normalizing. Things seem to be changing, right? I could take the share off, but as far as things with interest rates, I think you're going to see a little bit more of an interest rate change. You're going to see that the fixed rates are going to come down a bit more, and I'll share this with you guys.
So fixed rates, do you think are going to come down more?
Yeah, I think you're going to see rates drop significantly. I'm going to show you a chart here, just kind of what's going on with the mortgage rates. So let me just share this screen with you. I didn't want to do this as a presentation. It was more of just to kind of do it as a review, right? But basically, you can see the screen now, correct?
Yep.
Perfect. So mortgage rates, we saw variable rates, like we talked about, decreased, right, overnight, basically to 150 basis points, so 1.5% down to a quarter point. We saw a prime rate. Most lenders is now 245. TD is the only one with the higher rate. So this is what we've seen. If you look at that chart, you'll see that back in 2010, we were in the same place that we are today. Prime rate moved up. The overnight rate, this is the overnight bank rate, moved up, came back down, and then it skyrocketed, and now it just plummeted. This is a huge drop. With all this going on, what we're seeing is this might very well be the bottom of prime, but we didn't see the same thing happen with fixed rates, right? The cost of funds is also something that we need to be cautious of when it comes to mortgage rates. So let's just kind of touch base on rates right now. We expect that prime variable rates will come back down to prime less 70. Right now, there are a lot of lenders are charging prime plus 1. I think you'll see the recommendation right now from lenders is lock in, and I think that's a very self-motivated recommendation. It's the create a little bit of fear and get everybody to lock in when our margins are really healthy. The real recommendation should be, let's go into a variable, let's ride out the rates, and let's see what happens with rates dropping, the normalization of the cost of funds, if you would. In a normal environment today, the five-year variable would be basically 245 minus 75 would be roughly 1.7. But banks are not telling you that they can afford to do that, right? They're charging a premium and force you to lock in at a higher rate north of 2% because they don't want you to ride out the rate and get into the competitive environment. So right now, I think what we want to do with clients is when you're looking at fixed rates, they've gone up, the premiums, but this is the bond yields, right? What we're looking at right here. This is the real cost of money, right? So if we're looking at the 5-year bond bond yield is trading down here, which is basically, this was an older chart. It's gone down since then. It's sitting here now. This is how the banks get their money and secure it. So with the cost of funds right now, of the 5-year in a normal environment pre-COVID, with the current bond yield, the 5-year fixed rate should be 1.9.
How much?
1.9. Now, I'm not saying that we're going to see everything go back to normal exactly like the way it was. That's not realistic. I think what you're going to see here is like we saw in the credit crisis. We saw fixed rates take off, and we saw all the prime rate drop. Exactly what we saw here. We saw the spreads on the variables disappear, and everything went to prime plus, which versus prime less, which we're seeing here again on the variable spreads. But then, as things normalize, we saw those fixed rates all go back down more to in line to the traditional cost of funds. The difference is last time it took a year, and now this seems to be all happening at a much, much faster pace. So I wouldn't be surprised that when we start seeing the banks become more competitive and things are somewhat normal and there's more transactions in the marketplace, that the cost of funds will go back to a much more normal level sometime late summer or early fall of this year. So I think the strategy for clients now is, with interest rates, is take advantage of the variable, take advantage of lines of credit at prime, put yourself there so you can convert into a lower fixed rate when the rates finally come down.
So the overall recommendation right now would be to sort of stay in variable.
Yeah, so for now I would stay variable. And if you're in a fixed rate, I would consider possibly even moving to a variable. Because when you're, by moving to a variable, you'll be able to be liquid in the sense that you can convert to a fixed rate without penalty. The ironic thing is, if you're in a fixed rate mortgage right now, you could probably get out of your variable for a lot less than you normally would, because the way the kind of penalties are calculated, they're calculated on the spread and the cost of funds. And right now the banks are using the higher fixed rates that are artificially high. They're using those rates to calculate your penalty, so you can actually get out at a slightly better discount. Move into a lower rate at a variable, so you'll save some money immediately. If you want to prepare yourself to get ready to invest in something or buy another property, you can even access your equity in the form of a line of credit. Get ready, so yeah, you're ready to make a move, and you can benefit from when the rates do bottom out, because they will bottom out. The Bank of Canada's already pretty much said they're not going to be touching prime rate for the foreseeable future. And I think a lot of people suspect that rates will be like this for probably more than a year. And then the fixed rates could be somewhere around 2% for 5 years. So I wouldn't be locking in at 2.8 when the banks are obviously charging a premium right now.
Wow. Okay. Now, because I guess we're on the topic of interest rates, do you foresee anything happening with hyperinflation that would impact the interest rates?
That's a loaded question, right? So one economic theory is that, so the hyperinflation thing has been kicking around. It'll be interesting to see how a lot of debt has been created. I can't say for sure that the banks are going to start jacking rates up and there'll be major hyperinflation. What I can tell you is, during the credit crisis, when there was inflationary pressure, the world banks all artificially kept rates down. And what's happening there is they're basically, the Bank of Canada and all the other world banks around the world are buying all the mortgage securities. So they're basically buying the mortgage debt through the bond market, and they're keeping rates low. And we expect that to continue. So I don't think you're going to see hyperinflation on the interest rate side. You might see some inflationary pressure to try to reduce the burden of the new acquired debt over time, but I don't think it's going to happen in the short term. I think right now it's all about keeping things really low and inexpensive for the recovery, right?
Okay.
Yeah.
Next question, which I was a bit surprised to hear from you during our initial conversation, was about mortgage deferrals. From my conversations with many people who own homes, a lot of them did take advantage of the mortgage deferral. And only one of my clients who actually told me that they got a notification from Equifax saying, hey, you got a a non-payment, or I forgot, a hit or something. I forgot what it was, but basically a notification. And he was like, well, why would I receive that if this is, like, supposed to not impact my credit? So that was the only person I ever heard it from, though. Now, I heard something different from you, or something similar from you. If you mind explaining to people what the truth is behind taking advantage of this mortgage deferral.
Okay, so first let's put this into perspective. This is an extreme event. And when the deferrals came out, the whole idea of giving deferrals, I think the intentions were all very, very good, but it wasn't fully thought out yet. And my conversations with a lot of lenders, big and small, is just that in the beginning, is that they didn't really understand exactly how this was all going to play out. So right now, the message from the lending environment is that, look, if you defer your mortgage, we're not going to hit your credit bureau. Now, we all know that a lot of people did get their credit hit. We expect the message is that that's going to be reversed and corrected. So your credit rating from a credit bureau perspective shouldn't go down. That's the message. And I expect the banks to live through to support that and get that done. The other side of it, though, is nobody really understood how to disclose this to customers. So people are calling in and saying, hey, I need to defer my payment. Lenders had their standard checklist of questions that they have to ask you. And if you answered yes to a certain number of them, you automatically got your deferral. And a lot of people who probably didn't need a deferral ended up with a deferral because they were panicking. They were reacting to the media. But the lenders also didn't disclose to them what the possible impacts would be because they weren't really sure exactly how this was going to play out. So there was very poor disclosure. What's happened here is we found out obviously the compound effect of the mortgage being deferred is going to cost Canadians a lot more money over time. We also figured out now, as some of these deferrals have gone through, lenders are now asking on current mortgages, saying the first question they ask is, has the client deferred? And if you made a deferral, lenders are treating that as a delinquent payment. So what this means is they're basically saying that your credit rating is still the same. It's great, your credit bureau, but your internal credit rating at the institution is now going to change. So it reduces your ability to access money through a refinance or even for a new loan down the road. It's not the end of the world because I believe at the end of the day, logic will prevail and lenders are going to try to work around it. So now what they're asking for is, okay, if there was a deferral, why was there a deferral? They want to know what the impact that of the COVID has had on people's incomes, ability to earn, and now when we go in with an application with a client who had a deferral, we have to put a business case together as to why this shouldn't be used against them. But technically, it's going to count as a delinquent payment gone delinquent. Sorry, internally.
So, I guess, do you have? I guess if someone really needs to defer, is what you're saying, is that's when you should really be.
Yeah. So the intention of the deferral was always, hey, if you are going to miss your mortgage payment, take the deferral. Like, don't miss your mortgage payment, right? But if you are working or if you have enough income coming in that you can continue making your mortgage payments, that wasn't the objective of the deferral. So when that happens, lenders are looking at that and saying, hey, well, if you needed it, then you're probably not as financially stable as you thought, and that poses new risk moving forward. If you didn't need it and you executed, then that probably wasn't really good judgment, and that poses risk moving forward. So it's it's not the end of the world, but we're going to have to obviously mitigate that when discussing new loans for clients. So anybody who did a deferral and wants to get pre-approved to buy a property or even a rental or refinance, I would go and make sure that you qualify and you do your due diligence and you have lender support through credit granting. I wouldn't just be like talking to the banker or the mortgage broker and say, oh, you think I'm good, that's fine, let me go off and buy a property. I would make sure that you have it in writing from the institution that they support your pre-approval or your pre-positioning, if you would, because they could change their mindset if come later on when they see that you had a deferral, right? Because not everybody understands that you have to disclose this now, right? And it's going to be found out because lenders are going to do extra due diligence. They want mortgage statements to see if you have a mortgage at another institution they're going to want to see the statement for that mortgage to make sure that you didn't do a deferral. And if you did, how do we mitigate that? If you have a rental property, they're going to ask to see, okay, if you did a deferral, is that because your tenants weren't paying? What happened to trigger this deferral? So again, it's all about mitigation. So we have to kind of get ahead of it. But there is going to be some short-term impact on people's ability to borrow. They might need to put more money down, that kind of thing, when it comes to deferrals.
Okay.
But the solution is plan ahead. Plan ahead. Make sure you do your due diligence, and make sure the lender concurs that yes, you know what, we understand the client's profile. We've agreed. We understand there was a deferral. We're fine. We're ready to advance if you buy a new property.
Okay, so I guess I'm gonna ask anyone here if they have any questions that they would like to ask David with regards to the interest rates or mortgage deferrals before we get to our next topic. If you do, feel free to unmute yourself and ask, or feel free to write it in the chat button below. Yeah, I'll leave it to anyone who wants to ask anything.
Really hot topic, deferrals. No one's asking? I'm surprised.
Maybe they're just writing it down and we don't know.
Yeah.
Okay, well, you guys feel free to still interact if you guys want to while I go to the next topic, which is I have clients who want to buy properties. And if someone, here's a question, sorry. How concerned are you about deflation in the intern?
I think that'll be short-lived. I don't think that's something that we want to be very concerned long-term. Most of the population is still will be back to work when things are somewhat normalizing. So I don't think we're going to have a major deflationary pressure. So I think we'll be okay.
Can you explain to people what that means?
Well, deflation. People they're concerned about devaluation, right? I think in the short term, you're going to see some like when it comes to real estate specifically, I think you're going to see some real estate values in some sectors drop a little bit. You might see some distressed sales because people have committed to other purchases and they just kind of got caught in the middle. But that's if it's like the credit crisis that happened for 6 months and then it was all over. Here it'll probably recover a lot faster because this isn't an economic issue as much as this was a medical thing that kind of forced everybody. So when the economy starts going back to somewhat normal, I think you're going to see a lot of it will go back. So I'm not too worried about the deflation. I think it'll be devaluations will be very short-lived.
Okay. So if someone wants, another one. Okay. In regards to deferrals, what if you arrange an interest-only payment for 2 to 3 months as opposed to a full deferral? Do you think that will impact your bank's internal credit?
I think so. I think the minute unless the product you have, if it was like a line of credit type product where you can do interest only, that's different. You're within your right to do so. You haven't changed the terms of your agreement. But if you take your principal and interest component and you want interest only, banks will still make record of that. Because it gets added to it gets compounded in the back end of your mortgage. It changes their amortization. So yeah, for sure, I think that's going to have a small impact. It won't be as bad as a deferral though, and I think it's a lot easier to explain that than full deferral. So short-term impact.
Okay. If you want to buy a property right now,
Mm-hmm.
and let's just say it's an investment property, but a smaller investment property, meaning duplex, triplex, fourplex, not categorized as the commercial sort of larger multifamily, which is 6+. How are lenders looking at these, or how are buyers able to qualify in today's market?
Okay, so the message is it's business as usual, but the truth is, the ugly truth internally, lenders are saying that they don't want any investor mortgages, period. They don't want tenanted properties right now. They deem them at a very, very high risk level right now because there's still that whole concern that there's another quarantine in the future. And right now, there's a huge this disproportionate amount. Like I heard one lender told me that 50% of the deferrals, so half of them, were rental properties. So automatically lenders have now put the microscope on it. Now, it doesn't mean that they won't finance them, because they are, because we're doing mortgages for rentals. It just means that be prepared that they're going to do a little bit more due diligence. So it doesn't matter if it's 2 units, 1 unit, like a single family, or if it's 4 units. If it's a residential mortgage, you're going to find that lenders are going to start asking questions about the tenants themselves. They want to know, has the tenant made their payments through the COVID epidemic? Have the tenants, what's the tenant's employment status? Where do they work? Is their job secure? Some lenders will even ask for written confirmation from the tenant, signed, confirming that their employment is secure and they expect to make payments of their rent moving forward. So yeah, so there's going to be much more due diligence on the tenant. It's not going to be just the landlord anymore. And then when it comes to the landlord, it's also going to be liquidity. They're going to ask for a lot more liquidity. They're going to want to make sure that landlords will be able to withstand something like this in the future. That's going to be the extra due diligence, because you have to remember, like, these mortgages they're on the bank's balance sheet. They're not guaranteed, or like through CMHC, they don't have that creditor protection. So the banks are going to be doing extra due diligence. But yeah, it's not business as usual in that regard. Some lenders are going to charge a premium on their interest rate, which some were already doing anyway, but it'll be pretty minimal. But other than that, it's pretty much status quo. If for a landlord to buy a property like that, they'll still recognize the rental income if we can prove that the tenants are solid and they can make payments during the epidemic.
Okay, and how does this differ to the larger multifamily, like 6 units and higher?
Yeah, so if we go to like a purpose-built, which falls in the commercial platform, right? So your purpose-built 6-plex or more, that's different, because those type of properties we can get CMHC insurance on them. So we will with the CMHC insurance, it literally is business as usual. They want to see the balance sheet and they want to make sure that rent rolls are coming in, but they're not as aggressive as far as the interviews go with tenants and so forth. But again, it's because the banks are getting that guarantee from the government through CMHC that if this mortgage goes into default, they're going to pick up the loan and the banks stay whole, right? That security is why the banks are keeping it business as usual. So we haven't seen any change. In fact, I would say that we've seen a sharp increase in transactions in large multi-unit in the last little while.
How long do you think this is going to last, like with regards to like the difficulty of qualifying for investment properties? Do you see this being like until that sort of no eviction period ends, or do you think it'll prolong?
I think the way lending is right now with regards to the extra due diligence, I would expect that lenders are going to continue doing that for at least the next 12 months. I don't think they're going to ease off, simply because they're looking at their balance sheet, and if they look at their deferrals and they see a disproportionate amount going to tenanted properties versus end users, they're going to obviously take that into consideration, because if this was ever to come back again, they're going to want to hedge themselves against it, right? So I think you're going to continue seeing that conversation. I think lenders are going to start pushing the agenda of liquidity, making sure that people have some type of secondary financing in place, like a line of credit that they can access if something like this was to happen, or they have cash or investments that they can lean on if there was a problem in the market and tenants stop paying rents. So I think that's going to continue for the next 12 months, and then next year after the tax filing, we'll probably start seeing things normalize a little bit more over time.
In the interim, because
and then as far as the large commercial ones, I think that's going to continue very easily. The same process, same financing. That's not going to change at all. It's going to be just as easy today as it was yesterday and tomorrow.
Okay, so you basically answered my question there. We do have a question here. Do you know if most people using deferrals are just taking advantage of the program, or are they doing it because they are unable to actually pay?
So we know that some people were getting declined. So it's not like everybody got it right away. But I think that the due diligence from lenders started becoming more intense as they started the massive initial group of people requesting deferrals in the first couple of weeks. Um, I don't know. I don't think anybody really knows for sure if how many of these people were distressed. Um, you know, as far as the percentage, I think I have a stat here telling us roughly what it was, but yeah, it was like 500 million, right? So yeah, so I think that with regards to customers, I think a lot of people initially jumped the gun and did ask for deferrals, not necessarily understanding what they were getting. There was also a lot of people initially, which because we got this feedback from lenders that they thought that their mortgage payments were being forgiven. So they applied, and then they were shocked that, wait, what do you mean I got to pay this back, you know, down the road? So yeah, so unfortunately, I think a lot of people kind of got caught and just made bad decisions because they were poorly informed, and there was really bad media coverage. It wasn't really descriptive as to what the impact was. But yeah, well, time will tell how many people actually just took advantage of it. I would hope that most people needed it and didn't abuse the system, because everybody gets a mortgage today is paying for that deferral right now.
Say it again.
And everybody who gets a mortgage today, their interest rate has been inflated. Part of that increase in the rate and the spread of funds is there because they're paying for those deferrals. Those deferrals are not free, right? Like somebody else is not deferring, but you have to remember those banks still have to pay their investors their interest every month. So when they're making those interest payments, they have to balance their balance sheet somehow. And what they're doing is they're basically charging a premium for anybody who gets a mortgage today. And this is why another reason why I'm saying rates haven't bottomed out yet. Once the deferral payments are out of the system, the banks will have more room now to drop rates again, right?
Okay, so what type of opportunities do you see coming onto the market in the next little while? Meaning whether it's now, whether it's in 3 months, 6 months, 12 months, what do you see coming up?
So I think right now, I think one of the opportunities from a finance perspective is to basically rates are going to come down. So I think there's an opportunity to convert into something lower in the short term, and that'll probably be, I would say, once the deferrals are kind of panning out. So 3 months from now is when we'll probably start seeing the uh, real interest rates as far as true cost of funds. Cost of funds will be a little bit higher than they were before, but they should not at the level they are being priced right now. So that's an opportunity just to reduce your cost of capital. And if you're an investor, it's an opportunity to maybe re-amortize your mortgage. If you want to access capital, access at a lower interest rate, and prepare yourself for how you're going to move forward, right? But with regards to real estate, I think there's a lot of short-term rentals in the marketplace, and a lot of that stuff is now vacant. And I think you know, if the tourism industry is correct and they feel that this year is pretty much a complete write-off, that means that a lot of those short-term rentals won't see much activity until 2021. And a lot of those landlords are not going to be able to afford to keep those properties vacant. So I think you're going to see and which we're already seeing, an increase in the amount of units available for rent. With that increase of supply, and we might all of a sudden we're going to see the vacancy rate increase because those units were never factored into the vacancy rate, and we're going to see rents drop. So I think you'll see rents come down anywhere between 10-15%, you know, over the next six months. And the bulk of that will start happening when the deferral payments are out, and people start landlords are feeling the pinch of not having a tenanted unit. And then the other option on the buy side, I think you're going to see is once the deferred payments wear off, and some of these landlords find that they can't rent out their property through the Airbnb type market is dead. They're not able to get maximum rent like they used to. They may be forced or tempted to sell. So you might see some good deals on condos and multi-res in the short term, and that could last. I would say you might start seeing them 3 months from now because that's when the deferral should start ending, and that probably for until the end of the year you might see some good opportunities out there as things start normalizing. You know.
A question, 2 questions came up. So first one, I have one variable mortgage that is surprisingly now around 1.45%.
Mm-hmm.
Are all lenders doing the same reduction in variable rates as the others I have are fixed mortgages? In considering changing from fixed to variable, should one expect a cost to change from fixed to variable?
Yeah. So if you break your fixed rate, you're going to pay a penalty, right? So it's all about running the math. If the new variable is low enough that you're going to save, then it might make sense to make the move. I could tell you that prime less one, the 1.45, there isn't any lender offering that right now. Doesn't mean it's not going to come back, but that's probably going to take a couple of months before we see rates like that. So yeah, so I think the real play right now is because of the way the variables are priced is to possibly take a higher fixed rate, convert it into like a line of credit at prime, where it's fully open, and then this way, when the variable rates come down and the spreads are better and they're closer to that prime less one, if you would, or prime less 70, then you can go from one lender to the other, not have to pay penalty, right? But we'd have to do the math and make sure that it's worth breaking the fixed rate, because the fixed rate is going to have a penalty for sure. We can do the math very quickly. It's quite easy to do it.
Okay, and before we get to this next question, I have another question right here. Is those texted me. So, what is better, to pay off your house with a mortgage or home equity line of credit, especially how interest rates are low on lines of credit?
Pay off your house with a line of credit? Is that the question?
Yeah.
Well, if the rate, it's all about the interest cost. If your interest rate on your mortgage is 3.1 and you have a line of credit at prime at 2.45, if the penalty is not too high, then yeah, it could be beneficial to just pay it off and put it into the line of credit. And then I would, if you're going to keep obviously you're going to have a balance in your line of credit, right? I would wait out the market a little bit, watch rates come down and normalize, and then make the move into a mortgage. Because the reality is we expect 5-year fixed rates to end up somewhere around 2%. And we do expect the variables to start giving discounts again. Prime minus, the prime minus is going to come back, and I wouldn't be surprised if we end up with prime less 70, in before the end of the year. So yeah, I would definitely consider that if the cost makes sense. When you're looking at costs, don't just look at the interest rate. You have to look at the balance. So it's like, okay, if my mortgage I got 3 years left on my fixed term, and if I break this mortgage today, yeah, you're going to a lower interest rate. But you got to take that penalty, add it to the new balance, take that new interest cost, and term it out like the original mortgage, so you can line up the balance and make sure that your balance is less. If your balance is less than your current term, then you're going to be fine. If your balance is higher, then you have to reevaluate if it makes sense financially, unless you're refinancing and taking money out.
Okay.
So yeah, it's definitely worth looking into. But make sure you do your due diligence and make sure that whoever your mortgage broker, your banker is running the numbers. I just remind everybody that there's a big industry push to try to get people to lock in to fixed rates, right? Because like I said, the margins are quite beneficial to the financial institutions right now. So just don't fall into that trap. I think be cautious, look at the variable. Remember what happened during the credit crisis, and history will repeat itself. So there's always a real good opportunity to get to, if history repeats itself, to get a really, really low interest rate in the near future.
Okay. Next question is, are credit union lenders and B lenders also demonstrating this level of heightened due diligence?
Yes, everyone is doing it. So that hasn't changed. So expect the heightened due diligence to be common across the board. B lenders are even, right now at least, they're even changing they've changed a lot of the loan to values. They've required larger down payments. Yeah, so to kind of make themselves a little bit more, I guess, liquid in case it was a default. But yeah, so expect more due diligence for sure.
Okay, and so as a buyer right now, whether you're going out and buying your first home, upsizing, downsizing, or buying an investment property, what should we do now as a buyer? Should we wait? Should we go out and look? Should we prepare? And if so, how?
So I think as a buyer, if you're buying in a primary residence, it's a very emotional transaction. If you find the right property, and you're going to live there for an extended period of time, I don't think timing the market is always the best decision. And if you go back to history and look at the credit crisis, for example, there were a lot of people unloaded their primary residence thinking the world was coming to an end. And in 2009, the first 6 months, and in the last 6 months, they bought a house back at a premium. So because we remember, we ended 2009 at a record high in price point and volume. So I wouldn't try to time the market in that regard. If I'm an end user, you can be there for a long time. You're always real estate over the long time will go up, so you'll be fine. Just make sure that you're positioned properly and you're pre-approved, and you know that if you're upgrading, especially if you did a deferral, make sure that's been disclosed to the lender so it doesn't pop up and hurt you later as you're trying to complete your mortgage. And just so we're still seeing multiple offers on primary residences on a consistent basis, right? And especially in Toronto. So that's for the primary. For investors, I think I'd be getting prepared. Preparation is everything. So I would take the opportunity to reevaluate my portfolio, especially now when everyone's at home. You probably have a little bit of time to kind of go through your paperwork. Contact your broker or your trusted mortgage specialist at a bank, and review your portfolio. See where you are. Go through what your goals are, and it might be a good time to rebalance, re-amortize, take advantage of maybe a lower interest rate so your payments are reduced, which would be a great way to hedge yourself against rents coming down. Just get access to your capital, make sure your line of credit set up. And if you did a deferral, again, have that ready and disclosed with your pre-approval to make sure the lenders acknowledges it and understands that happened and they're still supporting the application. So then that way, when the time comes, you're ready to jump, because there are going to be some good deals. It's inevitable. After any kind of major economic shift, there's always going to be some opportunities. So then it's just really, as an investor, you want to be ready to jump, because as we all know, the market's still very competitive. And when the opportunity comes, you want to be able to just write a check and put your deposit in. And you may, unfortunately, have to go with no conditions. So you need to make sure your financing is solid and secure. So definitely I'll take time for due diligence right now.
But when you're saying get pre-approved right now, but how credible is that pre-approval right now?
Well, it is when we do it, because we send it to the lender. So we actually get our pre-approvals underwritten. I think that's what you bring up is a very, very valid statement, because a lot of brokers and bankers don't actually send their pre-approvals to credit. So that means they're giving you their personal opinion, but the reality is the pen that signs off on the deal is some credit grantor, not the person on the sales side. So you always want to make sure you have it in writing, and if it's dealing with a broker, you want to make sure that you're getting confirmation through the lender. There should be something from the lender confirming that your pre-approval has been reviewed. So we always make sure we use a bank to do a pre-positioning or a pre-approval to make sure that they understand and they've reviewed the credit, they've reviewed the documentation. Look, if you're buying a property, pre-approval for a house, or if you're pre-positioning your portfolio to refinance and buy a rental, when you do that pre-approval, if they're not asking for all your documents, then trust you me, that thing's not worth the paper it's written on. You need to be, if you're not providing all your income docs up front, you're not having the conversation about, if you did deferral and how that could or could not impact you, then, they haven't asked to verify where your down payment source is. If they haven't done all that, then I'm sorry, your pre-approval isn't very solid, and I'd be very concerned and I'd get a second opinion. But we always make sure we go to the lender. And when it goes to the lender, it's ironclad. The lenders don't do pre-approvals on exceptions. So they pre-qualify it based on what's there. And now this is the box we're in. Anything outside of that box is going to need an exception. And that's why we have conditions for financing.
Okay, I have a question that's been brought up to me on a number of cases, and I've read them in many reputable newsletters and even television, but how this compares or potentially could compare to the Great Depression or after World War II, and how this could have a much bigger impact than what we're talking about right now. How this could possibly normalize after a year, 18 months, or after a vaccination is discovered. But there's a lot more deeper stuff that's happening that is below the surface. that people are not really aware of. And I just want to know your thoughts on this, and how much do you think this is really going to be deeper than, I guess, what people are saying?
Well, look, I think it's foolish for anyone to say that we know exactly how this is going to play out, right? I think we have to look at history and see, okay, where in history have we seen big economic impact shifts, and what were the impacts, and how were the recoveries? I think the credit crisis is the one that we could probably relate to the best to this, because it had a very similar life cycle. It was during a similar economic times. So I think that's where the reference point I'd be using. The Great Depressions and all these other things, they were extremely economically driven, right? They weren't. It wasn't something that was to the level of this, where this is basically really a medical concern, and a constraint that forced everybody into home, and reduce the economy. Look, there's going to be a lot of small businesses that are not coming back. So, and this is the unfortunate reality. There's going to be a lot of, especially food and beverage industry, is going to be heavily impacted, where a lot of these restaurants just won't be able to open anymore. There's already evidence of that, where people are going online, and bankers are telling us that people are just telling me, I'm defaulting. I can't continue because I can't afford to open my doors, and I can't afford to keep them closed. I'm just out of business. So I think that's going to be there's going to be an impact there. But then the reality is there will be a period of time of high vacancies in some storefront commercial, if you would, that will ultimately balance out, because new business will come and fill those gaps, and these old restaurant tours will find new capital, and go back into the marketplace and create it. But the average Canadian they're still at work. Most people are still working, and a lot of people who are laid off are going to go back to work. On the higher paying jobs that really are where housing is going to be impacted more drastically. Bigger urban cities that are very service-based economies have a lot less impact than some of the probably smaller towns, where there might be manufacturing, or yes, small businesses that might, very small economies that are very localized and don't have the same bandwidth and flexibility of a really advanced economy. But I think that at the end of the day, I think those comparisons are they're very short-sighted, because we're saying, hey, we compare this to the Great Depression, yeah, today. But what we're not talking about is the Great Depression was an economy that was going from war times, that was being converted and changed into a complete new economy. That's not happening here. What we did is we've laid off a bunch of people, but those services and jobs are still there, and people are still needed. So I don't think it's gonna be as bad as a depression, nor take as long to recover. I think the financial industry might take 18 months to recover, to create confidence, because their financial reporting isn't going to be the best for the next little while. Airline companies, any company who's basically been grounded and shut down, yeah, they're going to have, the stock market may be very volatile for the next little while. But those are all kind of expected during situations like this. But yeah, I think overall the recovery is going to be, once the health thing is sorted out, like people get back to work, I think the recovery is going to be relatively smooth, because people are itching to go out and spend money. Everybody I talk to is just itching to go to a restaurant, or to meet somebody, or travel. People, the minute they can, they will. The question is how long do we have to wait? And that's the answer that nobody really knows, right? When things will normalize. So I don't think you're going to have a massive long-term impact. The impact that we're going to have is going to be the debt, all the government debt. How's that going to be treated? And that's where when you talk about inflation, historically, it's one way to deal with it, right? So will that happen? Hard to tell. It's a little too early, I think, for us to really quantify that. But when it comes to real estate, I expect rates to stay low. I think vacancy rates will go up, and I think people are going to get stunned by it. But that's because of the seasonal rentals that are coming on the market. I don't think it's actually anything to be too alarmed, because people still need to live somewhere, and the population isn't shrinking. So it's not a real indicator of what's going on. I think when people look at the news and they're talking about real estate sales are down 69% and all this, and everybody kind of gets all excited about that, the reality is yeah, there's less transactions, but the supply and demand curve is still to the benefit of the seller. That hasn't changed. And once people are back at work, consumer confidence will go up again. And consumer confidence is what dictates what happens with real estate values and rents. And I don't think that's going to be overly negatively impacted for very, very long.
Okay. Does anyone have any other questions for David or myself before we wrap this up? So I'll just wait for people. In the meantime, David, you're always awesome to talk to. I really appreciate it.
No problem.
I look forward to the time that we're actually able to do something in person.
So do I. Jeez, this is a little much for me, man. I'm going a little crazy.
Yeah. Yeah. We all have a bit of craziness going on right now, but I appreciate your time. And again, this will be recorded, so if anyone does want to contact you for any reason, feel free to reach out to me or David. I'll share his contact information afterwards. And yeah, so there's
a question.
Will there be a huge amount of rental units freed up from Airbnb rentals in Toronto?
I don't know the exact number, but I did hear, and I'll keep in mind that this was just hearsay through somebody. I don't know how accurate it is. That he seemed to think that there was 2,500 condos just in Toronto alone that were short-term rentals.
I think that's low. I think there's more than that.
Yeah, see, there could be even more than that, right? So, and look, and I know just looking at clients' activities and profiles, and when we see a lot of people that are using those seasonal rentals, actually they rely heavily on that cash flow, and when they lose it, I think they're going to be forced to make some tough decisions. And I think the only reason we haven't seen any real pickup in inventory is because the deferrals are still in effect.
And next question is, what are your thoughts on the appraisal values in the near term? Do you think banks will become more conservative with valuations given the uncertainty? That's a good question.
Yeah, so first of all, I think we have to clear something up. It's not banks who dictate the appraisal values. I think there's a misconception that banks have manipulated. That's not really the case. The appraisal values are determined by the appraiser, and they're governed through their association. And obviously, the banks have some input as to what those parameters are going to be. But in the short term, yes, I think it's inevitable that some people are going to have to sell in a bit of a panic. We're already seeing a little bit. We're hearing here and there where some people are dropping their sale prices because they have to move into another property, or they're just financially strapped. They need to figure something out. So I do think that that could impact values in the short term. If we start seeing a consistent price reduction across the board, then with that, I think you might see that values will drop, and then you'll see appraisals come low. The thing with appraisers is they have to appraise homes based on the most recent transaction, and then if prices went down, then that becomes a new trend. Until we see prices go back up consistently, then they can go back to normal. Sorry, there was another question there.
Yeah, and basically on appraisals, how are they being conducted right now? Are they going inside homes? Because a lot of these properties in the lab before COVID, they had to go inside. There was no drive-bys or automatic appraisals for the most part. So how are they being done now?
So the industry is definitely changed right away, and lenders have been very flexible to work with appraisers. So what we've seen is appraisers are typically doing drive-by. And they'll do a perimeter walk around the home in a lot of cases. Sometimes they'll even, believe it or not, just take pictures through the windows. And then they'll ask the customer or the homeowner to provide photos of the interior. Now, some lenders on the B side will say, well, that appraisal provides more risk because I don't actually have real evidence of the interior. I'm relying on the homeowner. So they'll scale back a little bit on the loan to value sometimes. So they'll, an extra 5% down, if you would. But there are appraisal companies that are still willing to go inside. There's very strict protocol with social distancing to make sure they're doing it right, and they wear all the protective gear, and then they'll go inside. But the first type of appraisal, like I said, with the homeowner providing the photos, is become more the norm right now. Yeah. At the end of the day, lenders, you have to remember, lenders are very confident in the Canadian real estate market for the most part. So there's not many lenders out there going, hey, we think real estate is going to crash. The consensus across the board is that real estate will be pretty solid, and because supply and demand is not going to change. Right? In fact, I would say that there might be a short-term price reduction, but then prices will rebound because there's going to be probably some supply shortages, in about a year from now.
Okay. Any last words of advice?
Look, my advice is always the same: is plan ahead. Take the time to take a look at your portfolio, plan ahead. If you found yourself in a situation where you needed to defer payments, think about what that really meant. That you probably need in the future to find some more liquidity and some secondary source of capital, either through lines of credit or for short term, or cash or investments that you can lean on. And if that's the case, then remember, that's what lenders are looking at too, right? So making sure you prepare yourself. So for me, it's just plan ahead, get yourself organized. Don't be too emotional if you're buying a rental property. Focus on the numbers. And if you're buying a primary residence, don't try to time the market. If there's something good that makes sense for you, and you have the financial capability of executing, then go ahead and execute.
Okay. Thank you, David, for all your wisdom. And this interview will be posted on my website and on my YouTube channel. So anyone want to watch it again or share it, feel free. Otherwise, thank you to all the viewers for coming out and listening and participating. And thank you, especially for you, David.
Oh, thank you. Thanks again. It's always a pleasure.
Absolutely, guys. See you later.
Cheers.